It's 6:47 a.m. on a Monday in San Francisco. A compliance officer at a crypto exchange is staring at her inbox. 68 pages just dropped from the SEC, and everything she thought she knew is about to change. For a decade, crypto investors have been asking the same question: is my Bitcoin a security or a commodity? On March 17, 2026, the SEC finally answered, and it's bigger than anyone expected. I'm your host, and this is Money Moves Daily. Today, we're breaking down the most significant regulatory shift in crypto history and what it actually means for your digital assets. Here's what you need to know up front. The SEC and CFTC just classified 16 major cryptocurrencies, including Bitcoin, Ether, Solana, and XRP, as digital commodities, not securities. That distinction? It's everything. Securities come with a mountain of regulations, disclosures, and restrictions. Commodities? They play by different rules entirely. This guidance opens the door to new investment products, clearer compliance pathways, and potentially a more mature crypto market. But there are catches. There always are. Let's rewind. For over a decade, the crypto industry has operated in regulatory limbo. The SEC pursued enforcement actions against various projects while refusing to provide clear guidance. SEC Chair Paul Atkins himself acknowledged this in his March 17 remarks. Quote, "The SEC's past reliance on regulation by enforcement helped drive digital asset innovation out of the United States. Companies faced subpoenas instead of workable compliance pathways. Some of the brightest minds in blockchain simply left. They took their talent, their capital, and their innovation offshore. Singapore, Switzerland, Dubai. These became the new homes for crypto innovation. American investors watched opportunities sail away while regulators stayed silent on the fundamental question. Was crypto a security? Was it a commodity? Was it something else entirely? Nobody in Washington would say. Until now. On March 17, 2026, the SEC and CFTC issued a joint 68-page interpretation. It explicitly names 16 cryptocurrencies as digital commodities not subject to securities laws. The list includes Bitcoin, Ether, Solana, XRP, Dogecoin, Cardano, Avalanche, Chainlink, Polkadot, Hedera, Litecoin, Bitcoin Cash, and Shiba Inu, among others. This is unprecedented. For the first time, a federal agency has drawn a clear line. These specific digital assets are commodities, full stop. And that changes everything for how they're regulated. But here's a critical detail. The guidance also spells out what's not a security: mining. Whether you're running a massive operation or a single rig in your garage is explicitly excluded from securities treatment. Solo staking, not a security. Custodial staking, also excluded. Wrapping tokens, airdrops without payment, none of these trigger securities regulations anymore. Now, this matters enormously for one particular reason: ETFs. The guidance explicitly permits staking activities within ETF structures. Let me say that again. Staking rewards can now be included in ETF products, with those rewards classified as commodities rather than securities offerings. Think about what this means. Right now, if you want to stake your Ether and earn rewards, you've got to do it yourself. Manage wallets, understand validators, take on technical risk. But with this guidance, we could see staking ETFs from major asset managers. Buy shares in your brokerage account, let professionals handle the technical complexity. Earn staking rewards through a traditional investment wrapper. This didn't happen in a vacuum. The Genius Act, signed into law on July 18, 2025, established the first comprehensive federal cryptocurrency framework in U.S. history. That law laid the groundwork. This March interpretation builds on it, providing the specific guidance that market participants have been begging for. SEC Chair Atkins was careful to set expectations, though. In his remarks, he said something important, and I want you to hear it directly. Quote, "This interpretation is a beginning, not an end." That's crucial context. The SEC isn't saying the work is done. They're saying the framework is finally being built. And more regulations are coming. By July 18, 2026, we'll see additional rules on issuer licensing, capital requirements, custody standards, and anti-money laundering provisions. California is adding its own layer too. The Digital Financial Assets Law takes effect July 1, 2026, requiring crypto companies serving state residents to obtain licenses. So here's where we stand. 16 named cryptocurrencies now have regulatory clarity. They're commodities. The CFTC has primary oversight, not the SEC. But and this is important, not all digital assets made the list. Thousands of tokens remain in uncertain territory. If your favorite altcoin isn't among those 16, its regulatory status is still unclear. The guidance also introduced a taxonomy beyond just commodity and security. Digital collectibles, including NFTs and meme coins, get their own category. Stablecoins, too. This matters because different categories mean different rules. Your Bitcoin and your Weird Frog NFT are not going to be regulated the same way, as they shouldn't be. Now, critics have raised concerns. Some consumer advocates argue that classifying assets as commodities actually reduces investor protections compared to securities regulations. That's a fair point. Securities regulations require extensive disclosures, registered exchanges, and investor protection mechanisms. Commodity markets have fewer guardrails. So what does this actually mean for you? If you hold any of the 16 named digital commodities, Bitcoin, Ether, Solana, XRP, and the others, you now have regulatory clarity. That clarity doesn't eliminate risk. Crypto remains volatile, and past performance never guarantees future results. But it does mean you know which regulatory framework applies to your holdings. If you're considering crypto investments, focusing on the named digital commodities gives you clearer regulatory standing. That's not a guarantee of returns. It's simply one less unknown in your risk equation. Here's something concrete. Mark July 18, 2026 on your calendar. That's when additional regulations on custody and capital requirements take effect. They could change how exchanges operate. That means the exchanges you use, the wallets you trust, and the products available to you might look different by year's end. Stay informed. These rules are still being written. Watch for new ETF products incorporating staking rewards. They could offer a more accessible way to participate in proof-of-stake networks. But consult your advisor about whether these fit your risk tolerance. The SEC has also initiated what they're calling a crypto sprint, a 12-month focused effort on spot trading and tokenized collateral. That wraps up in August 2026. But here's the elephant in the room. November 2026 brings midterm elections, and crypto policy could shift dramatically depending on who controls Congress. The current administration has been crypto-friendly, but political winds shift, and regulations written by one administration can be reinterpreted or rolled back by the next. So while this guidance is significant, genuinely landmark, it's not set in stone. The regulatory environment will continue evolving. Your strategy should account for that uncertainty. Let me bring this back to the human level. Remember that compliance officer in San Francisco we started with? The one staring at her inbox at 6:47 a.m.? She's been waiting years for this guidance, building compliance programs on guesswork and enforcement precedent, watching colleagues get subpoenas instead of clarity. This morning, for the first time, she has something concrete to work with. 68 pages of actual guidance, not perfect, not complete, but real. And that's the real story here. Not just what the regulations say, but what it means to finally have them. After a decade of silence, the conversation has actually begun. Atkins put it plainly in his remarks. For over a decade, market participants have operated without clear guidance on when a crypto asset implicates federal securities laws. That failure is now over. So what should you do with this information? First, and I know this sounds basic, don't panic in either direction. This isn't a signal to go all in on crypto. It's also not a reason to flee. The fundamentals of sound investing haven't changed. Diversification matters. Understanding what you own matters. Knowing your own risk tolerance, that still matters most of all. If you found this breakdown useful, consider subscribing. We cover stories like this every week, breaking down what financial news actually means for your decisions. But here's the honest version. Nobody knows exactly how this plays out. Not the SEC, not Wall Street, not your favorite finance content creator. The guidance creates a framework. Markets will fill in the details. Watch, learn, adjust. That's always been the game. Now we just have clearer rules to play by. That's the update on the SEC's March 17th guidance. 16 cryptocurrencies classified as commodities. New doors opening for ETFs and staking products. More regulations on the horizon. The crypto industry finally has its rulebook. It's just the first chapter, but after a decade of waiting, that chapter matters enormously. I'm your host. This has been Money Moves Daily. Until next time, make informed decisions, and remember, this is educational content, not financial advice. Always consult a qualified advisor before making investment moves.